Welcome to Allodium's Introduction to Financial Planning. I am Eric Hutchins, President and Chief Investment Officer at Allodium. We're happy that you've chosen to join us for today's session. This is an educational presentation about the basics of financial planning. It is not intended to provide legal or tax advice or specific investment or planning recommendations. The Allodium Financial Planning Committee has asked two of its members to lead today's session. Saul Bauman and Derek Van Calligan will be presenting. Both Saul and Derek are certified financial planning professionals. They each have more than 10 years of experience in the financial planning industry. We have budgeted 40 minutes for a formal presentation. At the end of the presentation, we have set aside 20 minutes to answer questions submitted by the audience. You are encouraged to submit questions during the presentation using the Q&A box in the Zoom application. I will now turn it over to Saul to go over the outline of today's presentation.
Welcome. The goal of this presentation is to introduce you to some of the ideas of financial planning. This presentation was created with younger people in mind who may be in their first job or starting a family. We want to share with you the things that experts think about. In designing this presentation, we thought, what do we know now that we would have wanted to know when we were just starting out? We hope you take away some ideas that you can implement to improve your situation. I wanted to start the presentation with showing you this pie chart. These are some of the main categories that we help clients with as comprehensive financial planners. In this presentation, we'll focus on the areas that we think are important for younger people to think about. Today, we'll be discussing the following topics. I'll start out talking about setting financial goals, budgeting and cash flow, building an emergency fund, managing debt, and planning for retirement. I'll then turn it over to Derek to discuss managing your risk, tax planning, estate planning, college planning, and financial plan review. A financial plan identifies, organizes, and prioritizes your financial goals, then outlines the steps you'll need to take to achieve them. A plan can help you see if you're on track to meet your financial goals or if you need to adjust your saving or spending. Your plan may include consolidating debt, opening bank or brokerage accounts, establishing a savings regime, and building an investment plan. There are several components to a plan, and all are needed to create a strong foundation for your financial future. When thinking about financial planning, a good first step is to define what we are planning for. People have all sorts of different goals, and these goals will likely change over time. Some of your goals may be vague, while others may be more concrete, and that is okay. The important thing is to start getting them on paper so you can think about them and start to refine them. If you have a spouse, this is a great exercise to discuss and align on your financial goals. Make your financial goals inspirational. Ask yourself, what do I want my life to look like in 5 years? What about in 10 and 20 years? Do I want to own a house, live in a different state? Do I want to be debt-free? Are a spouse and kids in the picture? In the longer term, what does an ideal retirement look like? After you defined some of your goals, a good next step is to organize your goals by how soon you'll need the money to fund them. Short-term goals are those you hope to achieve in the next 5 years, such as replacing a car or saving for a vacation. Medium-term goals are those you hope to achieve in the next 5 to 10 years, such as a down payment on a home or paying off student loans. Long-term goals are those that are 10 or more years away, including college for your kids, and of course, retirement. For each goal, specify a dollar figure and a target date. The more specific you can be, the easier it will be to identify and complete each next step, and it will help provide a sense of accomplishment as you work to make those goals a reality. You will need to get a sense of your monthly cash flow, what's coming in and what's going out. An accurate picture is key to creating a financial plan and can reveal ways to add more to savings or pay down debt. Seeing where your money goes can help you develop your immediate, medium-term, and long-term plans. The first step is to identify all your expenses, from rent or mortgage payments to one-off expenses. This doesn't need to be exact, but looking at a few months of bank or credit card statements should give you a good sense of where money is being spent. Then organize your spending into 3 categories: needs, wants, and savings or debt repayment. Determine how your situation compares to the 50-30-20 budgeting principle. 50% of your take-home pay should go towards needs, housing, utilities, transportation, and other recurring payments. 30% towards wants, dining out, clothing, entertainment, and 20% towards savings and debt repayment. This is just a rule of thumb, but if you are way off on these percentages, it may be time to develop a plan to spend less or save more. Now that you have a sense of how you are spending money and have identified your goals, let's talk about your safety net. Unfortunately, we all have unexpected expenses or setbacks coming up from time to time. These may be surprise car repairs or a job ending unexpectedly. Having an adequate emergency fund allows you to pay these expenses and know you can keep paying your bills and not compromise your financial goals. If you lose a job, an emergency fund can make the difference from needing to jump into the first job you find or holding out for your ideal job. A good rule of thumb is to have enough money in an emergency fund to cover 3 to 6 months of your needed expenses. If you have a working spouse and the likelihood of you both losing your jobs at the same time is low, you may be okay closer to the 3 months of spending level. If you're self-employed or have a very specialized job with not many job openings, you'll likely want to be more at the 6-month level or more. Keep this money in a highly liquid checking or savings account so you can access it quickly should the need arise. If these amounts sound daunting, you can start small. $500 is enough to cover small emergencies and repairs so that an unexpected bill doesn't run up a credit card debt. Your next goal could be $1,000, then 1 month's basic living expenses, and so on. Speaking of credit cards, you may think that financial advisors have a negative view of credit cards. I've worked with clients who have been proud to live within their means and not have a credit card as a badge of honor. However, when one of them applied for a mortgage, they were surprised that their lack of credit history disqualified them from obtaining the best rates. We recommend that most young adults obtain a credit card to help build a credit record. The important thing is to make sure it is paid off monthly, as the high interest rates on unpaid balances can quickly add up. Good credit gives you options when you need them, like the ability to get a decent rate on a car loan and a better rate on a mortgage. It can also help in areas you may not expect, such as obtaining lower rates on insurance and allowing you to skip utility service deposits. Many younger people have or will have some form of debt. Keep in mind that not all debt is bad debt. Some forms of debt are crucial for many people, such as mortgages, student loans, and car loans. A mortgage, for example, can help build equity. The types of debt that can quickly derail a financial plan are the high interest debts such as credit card balances, payday loans, and title loans. If you have any of these types of debt, we recommend making it a top priority to pay them off as soon as possible. If you have high interest debt, here are a few different approaches to paying it off. From a financial standpoint, the best approach is to pay off the highest interest rate loans first, and then move on to the next highest, and so on. This method saves you the most money overall. For some people, there's a psychological benefit to having fewer loans and prioritizing paying off the smallest loans first. Pay off the smallest balances first, and then redirect the money to the next larger balance, and so on. This method is best for people who are feeling discouraged by their bills. You get a little victory with each debt that you cancel out. A third approach may be a debt consolidation loan that could help you wrap several expenses into one monthly bill at a lower interest rate. If you find that you're in a cycle where you continue to add to these types of debt, it's worth taking a closer look at your spending. One method that works for some people is designating how much of a paycheck they want to set aside for certain categories. Say $200 for restaurants, $100 for vacations, and put the cash in different accounts. The accounts can grow in value or be used, but once the funds for a category are gone, you don't spend more on them. I remember my first jobs out of college and being overwhelmed talking to the HR staff about retirement account options and how much to save. I think many people can relate to not having very high paying jobs right out of college and feel pretty stretched financially. I remember thinking, I may not be saving a lot now, but I can catch up when I get my next higher paying job. And it's true that your pay likely will go up, and with it, your retirement contributions. But I want to share with you something that may surprise you. These are the monthly amounts that should be saved and invested starting at various ages to reach $1 million at age 65. For example, someone starting at age 20 would invest $292 every month until they turn 65 to build an account valued at $1 million. Now imagine someone else started saving at age 30. You'll see that they need to save $603 every month to reach the same $1 million. In other words, they need to save twice as much every month just because they waited 10 years to start investing. You'll see that every 10-year period that someone waits to invest, they need to invest over double the monthly amount as if they started 10 years earlier. If you talk with any financial advisor, one of the first questions they'll ask you is, do you have a work plan like a 401k? And does your employer match any part of your contribution? The reason for this is that the employer match is free money, and you want that. There's some different common formulas for how much the match is, but the bottom line is that the minimum you should invest in these types of accounts is what is needed to get the maximum match. Remembering the last slide, most people don't pick a certain dollar amount and stick with that monthly contribution for their entire working career. Most people's income increases over time, and the ability to save more also increases. If you're not able to save as much as you like now, make a plan to increase your contribution annually until you reach your goal or the maximum amount allowed. A reasonable goal may be to increase your contribution annually by 1 to 2% of your salary. As the money is invested before it hits your bank account, you'll likely not even miss it. One option you may have in a 401k retirement plan is the ability to invest after-tax money into a Roth option. What this means is that you pay taxes on the money that goes into the plan, but it grows tax-free and can later be withdrawn tax-free in retirement. This is different from traditional 401k contributions that decrease your taxes up front, but you pay taxes in retirement when the money is withdrawn. The decision of which contribution type to make depends on if you think your taxes will be higher in the future. If you find yourself in a lower tax bracket now, the Roth option is an incredible way to allow your money to grow tax-free. If you're fortunate enough to max out your 401k annual contributions, you may consider other types of accounts. The two most common are traditional IRAs and Roth IRAs. The taxation of these accounts is similar to the 401k options. Pay taxes now for the Roth and pay taxes later for the IRA. Both of these types of accounts have lower contribution limits than most work plans. The bottom line is that the sooner you start saving in a retirement plan, the better. Money in a retirement plan will grow over time and put you in a great position for future retirement. I'll now turn it over to Derek to discuss managing your risk.
Thanks, Saul. Insurance is an important part of risk management that protects yourself and your family financially. It's a way to offset potentially catastrophic risks like serious health issue, accidents, injuries, property damage, and worst case, premature death. Insurance can seem expensive at first, but if anything happens to you, it is well worth it. We should all know how important health insurance is, given how expensive even routine care can be without it. A serious injury or a hospital stay could set you back thousands of dollars. There are several different types of health insurance plans, such as health maintenance organizations, preferred provider organizations, point of service plans, and high deductible health plans. Each plan has unique features that come with various premium amounts. If you are younger and or generally in good health, it may be a good idea to consider a high deductible health plan. This type of plan is the cheapest from a premium standpoint. However, the annual deductible that you have to pay out of pocket is the highest of these four types of plans. This plan also allows you to contribute to a health savings account or an HSA. HSAs offer triple tax advantage in that you can contribute pre-tax dollars, which reduces your taxable income. The money then grows tax deferred, and then it is tax-free if used for healthcare expenses. This account can be used for medical expenses such as your deductible, or it can be used as another savings vehicle for retirement. These next two forms of insurance are especially important to consider if you have a family or other people depending on your income. Disability insurance coverage protects you and your family in the event that you are unable to work. Employer-provided disability insurance typically replaces about 60% of your salary. Disability insurance is often overlooked as most folks focus on securing life insurance coverage instead. In reality, you are much more likely to experience a disabling event that prevents you from working versus dying prematurely. A 2017 study by Group Market Share actually found that 1 in 4 Americans who are age 20 will suffer a disabling event before they reach full Social Security retirement age. Many short-term disability policies through a workplace offer pregnancy and maternal benefits as well, which is important to consider when growing your family. Life insurance is generally a good idea for those with dependents. Life insurance can replace income lost when a breadwinner dies, replace lost retirement savings, fund education expenses for children, pay off debt, or cover funeral or burial expenses. There are two main types of life insurance: permanent insurance and term insurance. Permanent insurance is exactly what it sounds like. As long as you pay the premiums on the policy, the coverage will last your entire lifetime. Term insurance, on the other hand, is temporary insurance that only covers a set number of years, most commonly 15 or 20. Term insurance premiums are cheaper than permanent insurance. However, that coverage does lapse when the term ends. Term insurance often makes the most sense for younger people. A common rule of thumb is to have at least 10 times the amount of your annual salary in insurance coverage. Now, this amount could be too much or too little coverage depending on your own circumstances. It's advantageous to work with a financial planner or insurance agent to understand what type of and how much coverage makes the most sense for you. Other important insurance coverage that you should be aware of is auto and homeowners or renters insurance, plus umbrella liability coverage. If you own a car or a home, or you rent and just can't afford to replace your possessions out of pocket, make sure that you're adequately protected. Shopping for insurance can seem like a really daunting task, but oftentimes, if you bundle these types of insurance with the same insurance provider, they offer you discounted rates on the premiums, which can save you money. Now, there are a number of ways to adjust your premium amount when it comes to these coverages. If you want to lower your premium, you may consider increasing your deductible amount, which would be the amount that you owe out of pocket if you were to file a claim. Now, it's important to have enough cash in your emergency fund to cover the deductible expense if you do, in fact, make an insurance claim. Another form of insurance to consider as you begin to grow your wealth is umbrella liability coverage. This type of coverage protects you from personal liability that may exceed your auto and homeowner's policy limits. Now, for example, if someone is injured on your property, or let's say is bitten by your dog and sues you, that umbrella policy could provide the extra coverage that you need. This insurance is quite inexpensive for the protection that it provides. Financial advisors typically recommend maintaining enough umbrella coverage to cover your net worth. Albert Einstein once said, quote, "The hardest thing in the world is to understand the income tax." I think most people can agree with that sentiment. Many tax-paying citizens only focus on taxes during filing season, but careful tax planning means looking ahead and putting yourself in the best position to minimize your taxes. Now, for example, if you're receiving a large refund each year, you may be paying in too much throughout the year. Conversely, if you ended up paying an underpayment penalty, you will want to monitor your income and possibly make quarterly estimated tax payments to avoid this in the future. Or you could consider increasing your withholding from each paycheck to avoid owing additional tax if you hold more than one job at a time, or you and your spouse both have jobs, which may move you up into a higher tax bracket. And if you have income from sources other than jobs, like rental income or self-employment that is not subject to withholding, it's often going to be advantageous to look closely at those withholding amounts from your W-2 income. There are over 215 tax breaks in the current US tax code that taxpayers can take advantage of in the form of exemptions, deductions, credits, and preferential rates. This can be daunting to try and navigate by oneself, especially if your tax situation is a bit complex. If you have many forms of income and available deductions or credits, it's probably going to be worthwhile to hire a qualified CPA to assist with tax planning and tax prep to make your life easier. If your financial situation isn't that complex, and let's say you only have one form of income, there are free online tax calculators and commercial software like TurboTax that you can buy that will help you plan and determine what amount to withhold or pay in, and what deductions and credits you may be eligible for. Now, an often overlooked piece of the financial planning puzzle is estate planning. For the majority of people, this is the last piece of their financial plan that they address. The reason being is that most people don't like to think about what happens after they pass away. I've heard many people say something to the effect of, well, what do I care what happens? I'll be dead and my kids can figure it out. This is not a great way to leave a legacy to your heirs, and a little legwork and planning while you're still alive can make a big difference when you're gone. For young families, it's important to draft a will for each spouse. Creating a will can help ensure your assets are distributed according to your wishes. If you have minor children, a will can name the person or persons that you would choose as the guardian of your children if both you and your spouse were to pass away. Along with the will, also consider establishing powers of attorney for financial and healthcare decisions in case you would become incapacitated. This allows someone to act on your behalf should you not be able to. Certain assets that you own pass by beneficiary designation rather than your will. These assets include retirement plan accounts and insurance policies. It's important to review beneficiary designations annually to ensure that the beneficiaries listed still follow your wishes. As you start to accumulate wealth, it may be advantageous to create trusts that give you even greater control of your assets once you do pass away. Assets titled in trust can also avoid probate upon death, making it easier for the distribution to your heirs. A lack of proactive planning can cause years of headache and tens of thousands of dollars in legal fees for your family members once you pass away. A carefully crafted estate plan that is articulated to your heirs while you are still living mitigates this risk of a messy estate distribution. College education is one of the more popular financial goals that people plan for. It's no secret that college costs have skyrocketed over the past 30 years. The price of 4 years of undergrad at a public university could cost close to $100,000, and a private school could cost close to about double that. After we have our own retirement savings well underway, most of us want to start putting money aside so our kids or grandkids can go to college or trade school in the future without having to take out massive student loans to cover this huge cost. There are quite a few ways to do this. Today, we will focus on the most popular college savings plan, the 529 plan. 529 plans are the most popular savings vehicle for education expenses. 529 plans are state-sponsored savings plans that have unique tax benefits relative to other savings and retirement accounts. Contributions to these accounts may receive a state tax deduction depending on the plan that you choose. Money in these accounts then grows tax-free, and withdrawals are tax-free if used for qualified education expenses. Another major attraction to 529 plans is that it has minimal effect on the child's financial aid eligibility for school. The plan is an asset of the parent or the grandparent and not the child, which could allow the child to receive more aid from the school. Parents can also change the beneficiary to another family member if the original child does not need or use all of the money. And beginning in 2024, unused funds in a 529 plan may be transferred to a Roth IRA tax-free in certain circumstances. This is a major change to 529 plan rules that offers now even greater flexibility for these accounts. There are tax consequences if the money is withdrawn and not used for qualified education expenses. Income tax and a 10% penalty apply to the investment gain that is withdrawn. There are additional rules which parents should research or discuss with their financial advisor before setting up a plan. This is also not the only savings vehicle that can be used for higher education expenses. However, it does provide more tax benefits than custodial accounts such as UTMAs or UGMAs. Your financial situation is rarely ever static. As you progress through your career and achieve life milestones like getting married and having kids, it's important to take a closer look at your finances to ensure that you're still on track to meet your goals and you're optimizing your current financial situation. Of course, we recommend working with a financial advisor to help you develop your plan and to stay on track. The Allodium website has a lot of great material that you can access to help you with any item that you may have questions on. Or you can simply ask us during the question and answer session, which is coming up next.
To summarize, today we talked about setting financial goals, budgeting and cash flow, building an emergency fund, managing debt, planning for retirement, managing your risk, tax planning, estate planning, college planning, and financial plan review. Please stay tuned for our question and answer segment coming up next. So our first question is, how do I choose a financial advisor and what are typical costs? Derek, would you like to take that?
Yeah, that's a great question. I'd be happy to take that one, Saul. The good news is for investors, there are a lot of free resources available online that you can use to find a qualified advisor in your area. Two of the more notable search sites are napfa.org and cfp.net. Now, you're also going to want to look for advisors who have relevant certifications in finance, such as CPA, CFA, or most notably in our profession, CFP, which stands for Certified Financial Planners. The Certified Financial Planner designation, it's probably the most well-known designation in the planning industry, and it shows that the certificate has a baseline level of knowledge in all parts of the financial planning process. Now, when it comes to compensation, there's a few different compensation structures that advisors are typically paid on. So there's fee-only advisors, which charge a fee based on to the percentage of assets under management, or sometimes a flat retainer fee for services. Fee-only is what Allodium is, and fee-only advisors don't earn any commissions from selling financial products. Now, there's also commission-based advisors who are paid on selling products such as insurance or investment funds, and this may create a potential conflict of interest. And then there's also fee-based advisors, which charge a combination of fees from clients and commissions. The most common way advisors are compensated is based on a percentage of assets under management, and the industry average overall is 1% annually.
Great. We have a question. Can you talk about the FIRE movement? So yes, so FIRE stands for Financial Independence and Retiring Early. So I have a good friend from high school that retired at the age of 40. And a few elements to this are reducing your expenses and saving aggressively. So my friend, for instance, could have afforded an expensive new car, but instead chose to drive a 20-year-old vehicle, although he chose a reliable one. So the exact savings rate will depend on your current income and, of course, how much you want to spend in retirement. But you may need to save at least 50% of your income or more, and of course, invest your savings wisely. So this includes having a diversified portfolio, stocks, bonds. Also pay a lot of attention to the costs of your investments. So oftentimes low-cost index funds, ETFs make a lot of sense. And then you'll really want to think about realistic goals in retirement, and you'll likely have a strict budget. So my friend, for instance, decided not to own a house, and this gave him the freedom to travel the world without being tied down. He also decided to settle down in a country that was much less expensive than America. Now, of course, the nice thing about being able to retire early is if, say, for some reason you got bored and decided you wanted to go back to work, that's always an option as well. Okay, we have a question on emergency funds and the best place to keep them. I'll take this one. So first of all, it's not a great idea to keep an emergency fund in your main checking account. Couple reasons: the yield's usually pretty low and it's really easy to spend it. So a savings account is a better place, although you'll want to look at the rates as they vary between banks. So big banks oftentimes will have lower rates, and oftentimes you can find higher rates at some of the high yield online savings account places that offer those. The important thing is that you want to make sure that whichever bank you choose is FDIC insured. Okay, we have a question on budgets. What is a good way to develop a budget that you can stick to? Derek, would you like to take this?
Yeah, this is another good question, and a question that I approach with a lot of clients, because I work with a lot of our younger clients who are really in that beginning stage of building wealth, and building a budget that you can stick to is really important. And when it comes to this question, there really is no right or wrong way to develop a budget. Really all that matters is that it's realistic and it's something that you can be disciplined and you can stick to. Me personally, I found that trying to account for every single dollar that comes in and goes out on a monthly basis is a pretty tedious process that I really just don't have patience for. What I found that works for me and my household budget is to really just first start with income. Figure out what is your net income that's being deposited in your checking account every single month. Once you get that number, then decide how much you want to save, whether it be in an investment account or in a savings account to develop your emergency fund. When developing a budget, you always want to pay yourself first and account for this dollar amount before you even start to look at expenses. So once you account for your monthly net income, how much you want to save, then I always like to look at my fixed expenses. So fixed expenses are expenses that really don't change much month to month. So this could be your rent or your mortgage payment, your car payments if you have a car loan, student loan payments, utilities. Like I said, basically any expense that's going to be similar month in and month out. So once you figure out your savings amount and then your fixed expenses, then the dollar amount that you have left over is your discretionary income. And for me and my budget, for my wife and I, this is money that we can spend on whatever we want throughout the month. So, 1 month we may go on a trip. So, that takes up more discretionary income, and I'm going to have less to spend on other things like maybe eating out or going shopping. I've really found this type of budgeting to offer a lot more flexibility with discretionary spending rather than sticking to a certain dollar amount for every single line item in a budget, such as like shopping, groceries, gas, things of that nature. So that's kind of how we've done it. That's how I've talked to younger clients in the past about doing it, and it seems to be what works for us pretty well.
Great, thanks, Derek. Kind of going off of that question, is there an optimal way to combine finances with a spouse, or should finances be separate between individuals in a couple?
Yeah, I can take this question as well because it's pretty relevant for my situation. Me and my wife got married about a year ago. So, the last year and a half has been trying to plan for a wedding and a honeymoon. So I've been watching our expenses like a hawk. And, this is another question where it depends on the situation and, what each spouse is comfortable with. So we've seen spouses keep finances totally separate or totally combined. And I've seen it with both strategies having success. So for me personally, my wife and I, we do a combination of the two. We found that helps really well. So we have a joint checking account where half our paychecks are deposited, and all of our shared household bills, like our mortgage, car payments, things of that nature, they come out of that account. And then we each have our own separate checking accounts and credit cards that we can each spend the rest of our paychecks on, whatever we want. So we found this to be a great compromise because, we can't get mad at each other for spending our own hard-earned money on things. that give us the most utility. So for instance, I like spending my hard-earned money on fishing things, and Kelly likes spending her hard-earned money on a lot of clothes, a lot of shopping. So we found that this this way of kind of combining our household finances really works well for both parties. So so I don't know if you have anything to add on that, on how you and your spouse do it, but that's how we do in our household.
Well, it sounds like a great system. We do something similar, although we have all of our paychecks go into one joint account, and from there we have a specific amount each month that goes out to each of us in our personal checking account. So we've defined kind of what our personal spending amount is, and like you, that's guilt-free money, where at least the idea is you can spend it however you choose without it being scrutinized. And I think that having that is important as you figure out what works best for your situation. Now,
Good.
Well, I am not seeing any other questions right now. So I think at this point, we will conclude our presentation. We thank everyone for joining today.
Great. Thank you, everyone.